Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to the first webinar in our exit planning series. Today's topic is building business value to close the gap. Now, I noticed a lot of familiar names on the attendee list. I know a lot of you have been a part of our past PPP webinars, and we're excited to start these webinars after a brief hiatus over the summer. We'll jump in here in just a sec, but a couple of quick housekeeping items. If you have a question during the webinar, open up the chat box in Zoom and submit your question to all panelists. We are going to try to leave quite a few minutes at the end for Q&A. Now, many of you are already clients of SVA, and we'd encourage you to reach out to your SVA contact if you have questions coming out of this. I'd also encourage you to share our contact details with other people you know looking to start their exit planning process who could use our help. Now, if you're not a client and you have questions, please reach out to me and I can get you connected to an SVA resource who can get those questions answered. So today we are going to talk about exit planning strategies, where to begin, what to look at and evaluate in your business, and how to go about planning for your transition. If you've attended our past webinars, particularly her PPP book club, you're already familiar with Nancy Melberg. Nancy is a principal with SVA and leads our management advisory services area. Also, I'll be introducing Erin Breber, who's a senior manager with SVA and is a CPA, and she works very closely with Nancy as well. So both Nancy and Erin help businesses through the exit planning process and help them maximize the value of their business. So I'll be back towards the end for some Q&A, but Nancy, I'm going to let you take it from here.
Thanks, Lee, and I hope this presentation is exciting as the PPP ones. I know we had a lot of attendance in those, and I really enjoyed my book club, so hopefully this will be just as much fun. So I think it's important that I give everyone a little bit of an overview before we jump into the topic of this webinar. And the topic of this webinar is really building company value and closing the gap. And I'm going to explain to everyone a little bit what that gap is. But before we do that, I just want to give you an overview of an exit plan, because an exit plan is really a process that results in a creation and execution of a strategy that allows business owners to exit their business on their terms and conditions. So some of the things that we're going to cover today is we're going to talk about what it is to create a successful succession planning. Boy, that's a mouthful. And we're going to look at the objectives that everyone should know, which is when, who, and for how much. And we're going to go into more detail there. And then we're going to go into a little bit more detail on closing the gap and building the value. Before we go into that, I would like to start out with a little polling question here. So I'm going to ask everyone, where are you in your current succession plan? And we have some options here. You have no plan in place at all. You just started your plan, or you're in the advanced planning of it. So I'll give everybody a minute to answer those questions. So it looks like, wow, we have 59% of the people on this call that have no current plan in place. So congratulations, you are taking the first step in understanding what a succession plan looks like. It looks like we have about 29% that just started, and we have 12% that are in the advanced planning stages. So that's some great input. I do have one other question here. And the next question is, what is your timing to exit your business? Are you going to look at exiting in 1 year, 3 years, 5 years, 7, 10 years or more, or you're really not sure? So I'm going to give everybody a minute to answer those. So it looks like we have about 16% that are within a year, 26% within 3 years, 16 and 5, nobody in 7 years, interesting, 21% in 10 or more, and 21% not sure. So hopefully those folks that are on the line that are in the 1, 3, or even 5 years, hopefully all of you are the ones that are in the advanced stages of exit planning, because a good succession plan really takes about 5 to 8 years to make sure that you achieve all your objectives. So we're going to go into that a little bit, but first, Erin is going to go over a couple of statistics with you that I think you'll find kind of interesting.
Hi, everyone. So of course, it wouldn't be well of us being accountants that we are if we didn't have a webinar that included some statistics. So BEI, or Business Enterprise Institute, which Nancy will remember for the remainder of this webinar here today, is a software company that actually SVA utilizes to prepare succession plans for business owners. And in their survey they conducted, they asked business owners their thoughts on succession planning, similar to the polling questions that we just gave you today. So their first survey that they had was, what percentage of business owners are expected to transition out of their business in the next 10 years? And the answer to that survey was only 79%. So if I look back to our polling question, that actually kind of adds up, because I think we actually came to 79%, ironically, that said between 1 and 10 years they were going to transition out of their business. So I guess our business owners on the line today are just in line with this BEI survey.
And I do think probably those numbers dropped because I saw a lot of activity in the last year with a lot of people exiting their businesses. The M&A market last year was incredibly hot. People were getting good values for their businesses. So my guess is that there were some individuals that might have been looking at 10 years that maybe ended up exiting a little bit sooner.
Right. So it is a hot market for those business sales, that's for sure. So their next survey that they gave out was, what percentage of business owners have discussed their transition plans with their family? And that result was 78%. So that means their business owners have, expressed their thoughts to your spouses and family members, but that doesn't necessarily mean that they've even discussed their intentions with their business advisors yet. So business advisors being attorneys, accountants, management team. So it's something to consider, that just because you put the plan out there doesn't mean we've actually communicated it with everyone that could be involved. And our final survey that they conducted was, what percentage do you think have actual plans in writing? And I think you actually will be quite surprised by this answer here. And it's only 17%. So that means only 17% of business owners actually have their transition plan in writing. That means 83% of people are flying by the seat of their pants, which to me is a astonishing number. When you got into your business, you typically made a business plan, but why doesn't anyone want to make an exit plan? Think of it as not having a will. Your business needs a will, not just a buy-sell agreement in case something happens to you. You need to have a written plan, and one that kind of crosses the T's and dots the I's and has a plan in place to figure out how are you going to exit your business.
And what's interesting, Erin, is this percentage also lines up, I think, a little bit to the number of individuals on this webinar that were in the advanced stages of the plan. So it looks like all of our viewers are right on track with the statistics here.
Always good to see that.
So one of the things that I want to touch on briefly here is there are steps in place that every business owner should be following in a successful succession plan. And those steps are on this page. We are not going to go through all of these today. Our goal today is to cover the first 3, and then the remaining ones will be covered in our other 2 webinars that Lee is going to mention at the end of this webinar. We have a series of three webinars covering this topic. Erin and I are going to cover the first 3 today, and then the last 4 will be covered in future webinars. So really what we want to look at is we want to look at and identify what the owner's objectives are. And Erin's going to talk about that next. We also want to quantify business and personal resources. I'll explain what that means. Maximize and protect the value that we're going to go into detail on. Look at selling your ownership to a third party or to an insider. So these steps are not going to be for everyone because you're either going to sell to a third party or an insider, but chances are you're not going to sell to both. And then you want to look at business continuity, and that's for lifetime or at death. And again, those will be covered in future webinars. And then the personal wealth and estate planning. But for now, we're going to go into identifying an owner's objectives, and then we'll continue with the other two. With this presentation, this is just a graphical format that I want to share with everyone, because this really shows how your business and personal financial resources and goals have to align up. So when you're looking at a successful plan, you need to look at what your owner objectives are, your personal goals, and your business goals to really establish a good comprehensive plan. And with that, I'm going to let Erin kick it off with the objectives.
So typically when you're thinking of exit planning and you're selling your business or, just transitioning out, you kind of have to think of three main objectives. When do you want to sell or exit? To whom do you want to sell or exit to? And for what price do you want it for? So these three objectives are basically a systematic approach that you can look at to figure out what are your end goals when you're retiring and what are you trying to get, what are you trying to get to? And all these areas are to help you narrow down your objective to get the best option for you. So our next slide here, sorry, there's a little bit of a delay, sorry, is, just getting started. So when you think about it, this is the one area that you might change the most often. When you are thinking about your exit plan, things that are outside influences could definitely change the timing of when you're planning to exit. It could be just the market. I mean, people that were thinking about exiting maybe in early 2020 might have changed their objectives because of the whole pandemic that all of us went through together. Another one is, just market values, just personal objectives could be different. So getting into business is one thing, but getting out of it is a whole nother aspect. And it's guaranteed you will eventually exit your business in some fashion. But the question is, how are you going to get there and how are you going to help make that happen? So exit planning. Whoop, sorry. Go ahead, Nancy.
I was just going to say, I think this is a perfect graphical presentation because it's really about putting a stake in the ground. Understand that that stake is going to shift and it's going to move along the way, but you have to start somewhere. And this is just the start.
Right. It is all about getting started. So actually up next, we have another poll because, we're all about participation. And our next polling question is, who do you plan to sell your company to? And if you don't know, obviously that's one of our answers, but we have insider, third party, an Esop or an employee stock option plan, or not even sure. So we'll give a couple seconds here for people to respond. I feel like we need some Jeopardy music maybe. Okay, so, surprising, 52% of people are not sure. So, and 0% say Esop. Okay, that could be that maybe we don't know what an Esop is. A third of you said third party and 14% said insider. So actually Nancy's going to talk about the different parties that you do have options to sell to, but those are typically the ones that we see and wants to start considering if you are starting those planning phases of selling, exiting your business.
So when we look at the three main objectives, when, to who, how much, we're going to focus on the who. And so I saw from that last poll that 52% don't really know. And my guess is because they don't have sufficient information to understand what the options are. So some of the options are, if you have family members working in the business, you have options to gift and or sell shares to family members. This is important that we do want to make sure that family members who are working in the business understand the business, and you want to be successful in transitioning that onto a second or even a third generation. So it's important that you really have them work in the business first. Insiders could really be your management group. So oftentimes we have management groups in place at organizations that are really more than capable of running the business. And we're going to talk a little bit later about why that's important to make the owner irrelevant. So you may have managers, either a group of managers, one or two managers who have approached you or are interested in purchasing the business. Perhaps what's holding them back is they don't have sufficient funding. Well, there are ways to get around that. There's a lot of seller financing available, SVA loans. So there's options there that insiders could come in and buy the business from you. You could also sell to Esops, which could kind of be considered an insider. That's, as Aaron said, it's where you're actually selling the business to your employees. You've heard a lot of advertisements for certain companies that they're employee owned. That's because they're owned by an Esop. That's really gaining a lot of momentum right now. And, you know, there's very specific reasons why people want to keep their employees. People want to keep the legacy of their business. One of the things that people have to consider when they're looking at who is what are their objectives or their goals in selling it? Do they want to leave a legacy or do they just want to get the highest price? If you're looking at possibly just getting the highest price, you might want to look at a strategic buyer or competitor. So a strategic buyer is a buyer that owns similar businesses and they're going to come in and they're going to consolidate, very much like a competitor might. They might be able to eliminate some of your administrative, and they might just consolidate into their organization. So typically they're going to have savings there and they're going to be able to see where profit's going to ramp up quickly. There are also private equity firms right now that are buying a lot of businesses. So that's an option as well. So it's really important to line your personal objectives with who you're thinking about selling and then go from there.
So now this part is, we went over the when and the who, and now it's for how much. So the third objective in exit planning is for how much. That price is based on knowing the answer to how much is my company worth. One of our future webinars, actually the one that's coming up next in our series, is going to help you calculate what the value of your business is. But it's important to know that there are multiple ways to value your business. It's not just, looking at your bottom line and saying that's the value of my business, or looking at my assets and saying that's what my company is worth. There's multiple ways to come up with a value for your business. It could be you use a multiple of your Ebitda, which will give you an example of what Ebitda is and how you can use that to calculate your business value. It could be a multiple of your seller discretionary expenses, or it could just be based on your company's cash flow. So just think of it like when you're selling your home, there's multiple ways that people will value the price of, or value your home. It's just like your business. There's multiple people that will come up with different answers on how they're going to value your business. And it's whether that value is what you're looking for and what will help cover your needs for when you want to exit your business. So Nancy's going to kind of talk about our second step in this BEI 7-step plan.
Yeah, so we really want to quantify the business and the personal resources. And so what we're really talking about here is we're talking about the asset gap. And so I want to explain to you what that asset gap is. And it's a very, very simple equation. It's understanding the difference between what you need to retire and what you have. And so in order to do so, you really need to determine the value of your company. And this is where you're going to use one of those methods that Aaron talked about to determine the value of your company. And then you need to determine what your needs are in retirement. And this needs to be a very, very comprehensive plan. We recommend sitting down with a wealth advisor, and we recommend going through this because this is going to help us determine what you need to get for your business. And if your business is not valued at that amount, how can you increase the value of that? So when you're really looking at income in retirement, you're going to look at all sources of income. And so you're going to look at Social Security benefits. You're going to look at what you sold the business for. You're going to look at what type of expenditures you have. And this is really important that people understand. They need to consider things that the business was previously paying for that will no longer be an available benefit to them. The biggest one, probably health insurance. If you are retiring before you're the age of 65, then you're not going to be able to get Medicare, and you're going to have to provide health insurance for yourself unless you have a spouse that's still working that gets health insurance. That is probably one of the biggest costs. You need to consider that. You need to consider your vehicle. Most business owners have their vehicle in the company because they're using it for business purposes. So the company's probably paying for the car payment for the insurance of the vehicle, the gas, the maintenance. That's something that will also go away. So you have to think about those things when you're planning for this. You also have to look at, what do you want to do in retirement? You know, I hear a lot of people that say, oh, I won't need a lot of money. And then when you start to ask them, well, what are your plans? They say they want to travel. Well, traveling can be expensive. And so where do you want to travel? How often do you want to travel? Do you need a second home? So those are all things that you need to consider. So on this next slide, we have just a little bit of a worksheet where you're going to start laying out. These are just some of the items that you want to lay out, that you're basically your inventory, your income is, to start this process. And again, I highly recommend that every individual on this call meet with a wealth advisor, fill this out, gather the information, and then meet with them to determine. They can tell you what you need based on your life expectancy and the expenses that you need based on the income you have. I will say that this tends to be a little bit overwhelming to people, and they tend to get a little bit hung up on this piece of it. This does not have to be perfect. You know, when you're meeting with them, you do not need to have the very last statement and have, you know, the dollars and cents down. It needs to be just rounded, a general idea of what you're going to have, so you can start to have those conversations to figure out where you're at. So the next step is, what do I do if I have a gap? And I guarantee that there are a lot of individuals out there that have gaps. People tend to think that their business is worth what they need it to be worth. That is rarely the case. There have been some excellent situations last year where people got more than they anticipated. I love to see that happen, but that doesn't always happen. So you need to figure out, what am I going to do to close the gap? So you have a couple of options. You can continue working. And honestly, I have actually told people that this is probably what they should do. If you have a business that you get a good salary from, you're taking some decent distributions, it's providing a good lifestyle for you, and you can't make that up, and you have too big of a gap, perhaps you need to stay and work for 5 or 10 more years, or build the value of your company. You can just get what you can for your business, and you can change your lifestyle. That's an option. If you wanted to travel and you can't travel because you're not going to get the money you need, that's an option people have also. They can change what their goals are. And then the last one is the one we're going to spend the rest of the time focusing on, is really building the value of the business. So how do I build that value so I can get what I need to get out of my business?
Yeah, so the third step, just like Nancy mentioned here, is, maximizing your business's value and protecting that business value. So, you've decided you're going to sell it and you know how much you need to sell it for, but now it's, what is my business's value worth right now? Or how can I help improve that? So we're actually going to come up with another poll question for everyone. And
Yeah,
Nancy,
so we
I
have
can
a
take
quick-
that one for you if you want.
Yeah, we have a quick poll here. How do you know the current value of your company? And this is always interesting to me, to see what people answer here. So we'll take a minute and gather these results. And I have a feeling I know what most people are going to say. Oh, wow. I was wrong. I actually thought we'd see a much higher percent of people that had a gut feeling. So we have a lot of folks out there that actually have had a valuation done. That's interesting, but we still have 53%, if I can read that right, 53% of individuals that have a gut feeling. So there's still a lot of folks out there that really don't know. So you want to start to think about taking the steps to get that information. You really don't know if an offer that you've received is a good deal or not if you have no idea the value of your company. So you need to always know, I always tell people, don't run your company like it's for sale, but be ready to sell it immediately. And part of that means understand what the value is of that company. And so now with that, I think we're going to get into the meatier part of our presentation here.
Right, the part where everyone's like, all right, so how do I actually build the value of my company? So it's not magic. There's actually a system that SVA uses called the Value Builder System that measures the risk in your organization by you just taking a simple test. Well, it's not simple. I think, what is it, Nancy? About 70 to 80 questions about. And you're muted.
This one's not as many. This one is about 40.
Okay, well, still 40 questions on these various areas of your business, and it helps you identify where those risks are. So companies who score 80% or more on this Value Builders system test typically sell for 70% more than their peers do. So we'll go through these 8 drivers, or just key areas that focus on different aspects of your business, and kind of just explain what each of these drivers means and ways that you can help to improve them, and how those drivers can impact the value and your multiple that you can get when you're getting ready to sell your business.
So I'm going to focus on the first 2 drivers, and Erin and I are just going to tag team here and go back and forth. The first one, believe it or not, sounds like it would be the simplest driver to get a good score on, but believe it or not, this is actually the one where most individuals fail on, is providing good financial information. This does not mean that you need to have an audited financial statement or even a reviewed financial statement, but what it does mean is you need to have accurate information. It's very, very important that when a buyer starts to do some due diligence on your organization, that they don't lack trust in the numbers, that they have accurate information. I think in our next webinar, Nikki's going to focus on some due diligence a little bit more, but this is the first impression that a buyer will get of your company, is they're going to ask to look at financials, and they're going to want to know that those numbers are accurate. And then they're going to want to look at some successful results. They're going to focus on top line revenue, bottom line income, making sure that those numbers make sense. The other thing that we always encourage people to do is to departmentalize if they have departments in their organization. If you have a company that you sell equipment, but you also install and service equipment, it's going to be very important that you segregate that information. This is also something that I talk to a lot with subcontractors, like electricians, for example. If you actually do new construction electrician for new homes or buildings, and then you service, because believe it or not, the service part, and we're going to talk about that in a little while, that actually can get a higher multiple because it's a little bit more reoccurring revenue. So you want to make sure that you're isolating those on your financial statements so you can prove why your company is worth what you think it's worth. So again, sometimes they say this is like looking at a new home, and you see it online and you say, wow, that looks nice. And you drive by it and the outside looks really nice. And then you make an appointment to see it, and you walk in the door and there's green shag carpeting and gold appliances. You don't want to be that house. You want to make sure that the outside matches what's in the inside. The other area that is really important is looking at growth. And this is really the capacity to grow. A company that is already at capacity is not going to be worth as much as a company that has capacity. When somebody looks at buying your business, they want to buy it because they want to take the business to the next level. I had a situation where I had somebody looking at buying a company in, I believe it was Indiana, and they were excited about the numbers. They were excited about everything they saw. And then we went down there and we toured the facility, and we realized that they were at capacity, that there was no possible way that they could extend their revenue based on the facility that they had, the equipment that they had. We found out that the equipment couldn't be moved to a larger facility. Well, guess what happened to the value of that company? It just plummeted because we didn't have capacity. So capacity is very important, and it's important to show a buyer where that capacity, how you can grow that. And again, that's going to be through revenue expansion. If you are selling equipment, do you have the ability to also service that equipment, to have a service model in place? So how can you expand the revenue and play off of what you have? And then the earnings predictability. This is where we kind of talked a little bit about reoccurring revenue, because you want to be able to project what those earnings are, kind of hard time with that word, into the future. And so this is where these two drivers are going to be really important, because you want to be able to see what's happening into the future. And now Erin's going to look at the next two.
Yeah, so these next two are all about balancing things. So the third one says independence. And what we mean by that is basically being not reliant exclusively on either a single customer, but also not being reliant on a single vendor, a single supplier, or even just your employees. So it's all about not putting all of your eggs in one basket. So independence is also goes by the Switzerland structure. So it's kind of thinking of it as being kind of neutral to your customers and vendors and employees, so that you're not being reliant on just one single source. I always think of it as like the 80-20 rule. Like you don't want, 80% of your revenue coming from 20% of your customers. That's not always the best way to structure your business. But there is also a balancing act, because let's say, for example, you have vendors where if you buy a certain quantity of products from them, you can get rebates depending on how much you sell or buy from them. So it is somewhat of a balancing act, but just be mindful that you don't always want to be reliant on either one employee or vendor or customer, as that could impact your business's value. The next one is working capital. So working capital is basically, I like to think of it as your company's cash flow. It's the difference between your receivables and your inventory compared to your accounts payable. So I do have some clients that are very proud of themselves, and they say, oh my gosh, I pay off all of my vendors all at once. I have no payables. Well, that's really great, but maybe not necessarily from a cash flow standpoint. Think of it as you're paying people quicker than maybe the money is coming in. So you don't necessarily want to have more payables or actually more receivables than you do payables. You might actually want the exact opposite of that. Because think of it this way, if I have more payables on my financial statements compared to my receivables, that means I'm collecting more cash than maybe I'm paying it out. So when you're working on your working capital, that's kind of funny, a little pun there. But when you're working on that, it's a very important balancing act to make sure you have the right receivables and inventory to your payables. Because when you're getting ready to sell and a company and your buyer is coming in and buying your assets, they're buying those numbers from you. So it's kind of important to just, be mindful of where you need to be at to run your business. And that's something that they're going to look at, because when they're stepping into your shoes, they're going to want to be able to have that same structure in place.
Boy, we do have a little bit of tongue twisters in here, don't we?
We do.
One of the things that I also want to point out about the independence too is I kind of think of this a little bit from a sports theme here, is that when you're looking at suppliers, and as Erin mentioned, the discounts, the thing that you want to do though is you want to make sure that you have somebody on the bench. When you think about a football game, we always have a quarterback that we want to start, and we hope that that quarterback makes it through the whole game. But gosh, what happens if that quarterback gets hurt? We better have somebody else on the bench. We better have somebody that can jump in the game. We need to have that same thing with suppliers, especially right now with all of the problems everybody has experienced with supply chain management right now. It's horrible. I'm sure everybody's watching the news and they're doing everything they can. But think about that business that had all of their eggs in one basket and can no longer find a supplier to give them the product they need. it's important that you always have a backup plan and you always have somebody on your bench. And it may mean using them every so often and maybe losing a little bit of a discount from your main supplier, but that's important to make sure that they're available to you if you need them. So the next couple of drivers that I'm going to talk about here. So we talked a little bit about reoccurring revenue, and I want to talk about why this is so important. So often companies kind of chase the work that they're getting. And if you can find a way to have that revenue that you get automatically reoccur, sometimes you might have to provide some type of incentives. But how many times have you ordered something? I know I am guilty of it with some face cream. You order something and then all of a sudden you realize you're getting shipped every single month for it, and they're charging your credit card every month for this face cream. This is something that you want to think about. What can you do with your business? What can you sell that you can automatically repeat? And again, service is a great option. People offer service contracts. Maybe they buy something and then they are also buying a year's worth of service. Maybe it could be billed automatically monthly, and every year that service renews, selling products, whatever it might be. You want to create a way to automatically get that revenue reoccur, so you don't have to chase it as much. And it gives you the predictability we talked about, so you can actually look at your sales in the future and you can budget. Reoccurring revenue is probably something that increases your multiple when we're looking at valuing a company quite a bit. Number 6, control. This is actually my favorite one. I like to find ways to differentiate from other people. We like, as an accounting firm, to figure out ways that we can differentiate ourselves from other accounting firms. One of those could be providing webinars like this, or doing things like helping people with their PPP applications. But what can we do to really set ourselves apart from our competitors? And sometimes it's looking at what customer needs are. We talk about this a lot within our accounting firm, that whatever we change or add as a revenue or service always comes from looking at what our clients' needs are. And that happened to be the PPP last year, or the HHS funding, or the employee retention credits. Clients needed this information. And so we were able to say, hey, let's get on board and provide this. This is something that I think every organization should challenge themselves to do, because if you do that, then you're going to have a little bit more ability to have the pricing strength, because you're offering something that no one else offers. I want to just tell you a quick story that was part of the value building webinar that I had sat in on, about some individuals that bought a flower shop. And the typical flower shop was people would come in and they would buy flowers for holidays, Mother's Day, birthdays. And they really sat back and they said, what are some other customer needs, and what can we do to A, increase some reoccurring revenue, and B, provide a service to people? And then they realized that a lot of office buildings, when you would go into the reception desk, they sometimes had flowers up on the reception desk. Or if you went to a nice restaurant, they had flowers on the table. So they started going and knocking on doors. And before we knew it, the business that they had purchased that maybe had $1 million in revenue very quickly grew to $8 to $10 million in revenue. And they had all these reoccurring sales because they created something where they automatically went in to all of these different locations and every week provided fresh flowers. So it gave the customers that they were dealing with, it gave their customers a better experience, and it provided them with some predictability into their sales, and it really differentiated them from any other florist on the block. So this is where I think everybody can challenge themselves and think outside the box a little bit to figure out what you can do as an organization to create that. And so Erin, I'm going to let you jump to the next two.
All right, so these are our last 2 drivers in areas that are all about customers and your management team. So the first one there, number 7, is loyalty. So what that means is your customer loyalty or your customer satisfaction. And maybe people have heard of this, but there is a way that you can actually take a survey with your customers to test to see how loyal they are to you. And it's a survey called the Net Promoter Score. And it's basically it's one question that says, on a scale of 1 to 10, how likely are you to refer someone to this business? And how this Net Promoter Score works is if you have people that score you in the 9 or the 10 area, they're considered attractors. They're ones that are actively promoting your business, sending referrals your way, telling people that they need to go to your business and buy your products. For people that score you in the 7 to 8 range, they're considered passive customers. They come to you when they need something, but they're not actively promoting your business to other consumers. And then you have the 1 to 6 range, which are considered the detractors. They're ones that are not loyal to you. They're ones that, maybe they'll go to you if it's convenient, but they're not actively trying to come to your business. So it's actually a very simple survey. I actually took one the other day I bought some stuff on Kohl's and they sent me a survey and I filled it out. So it's very common and you probably don't even realize why they're doing it, but they're just trying to gauge what their customers' loyalty or satisfaction is at.
And Erin, one of the things before you go on to management depth, one of the things that I actually recommend in doing the Net Promoter Score is add a question that is 100% optional that just says why. And the reason is because people by nature have a tendency to want to tell you if they're dissatisfied with something or they're unhappy. If they're happy and they love your service, they have no problem giving you a 10 and moving on. But if they're unhappy because if there was a very specific situation that might have caused them to score that, they do want to tell you. So I think it's important to always add optional why, because this will give you some insight in some areas to focus. If you do get a low score, this is where you can start. And then once you start putting a plan in place and making sure that everybody in the organization understands how important customer service is, I would say retake the test within about 9 to 12 months and see if you've gained some better scores after that. But it's just putting an optional why on there can sometimes give you some insight.
And we actually, SVA has done it. We did it a number of years ago. So it's something that every business can easily do and send out to their customers. So this last driver that's part of, figuring out your business's value is the management depth. And determining, one, do you even have a management team in place? Or is the business solely reliant on you to generate, the business, basically? This area is about changing the owner's mindset from needing to be all in on the company details to one being focused more on the higher level areas and also being able to plan for the future. If your company is solely reliant on you to bring in the business, monitor employees, if you're trying to sell your business, it's going to be hard for someone to basically take over when you're the one that's doing most of the work. So it's more keeping it in this mindset of going from being hands-on and head down to being hands-off and having your head up. So now you're not in the weeds, but now you're up in the clouds and trying to, help plan for the future and build your company's value and, relying on a management team that could transition with a new buyer if that's the plan for what would happen with them. So those were basically our 8 drivers that we wanted to just give everyone a little bit of a background on. And the next thing is once you take your test, Nancy will kind of give you a little bit more insights on those. So Nancy.
Yeah, so there is a value builder score that you can get. You can take an assessment and get a score that will, as Erin mentioned earlier, give us some insight into the weaknesses of your organization. You will be scored independently in all areas of this, and then you will also get an overall score. So as Erin mentioned earlier, that 80% or businesses that scored 80% or higher sold for about 70% more. Getting 80% on this is not an easy task. Every business has weaknesses somewhere. And this is where we can really help you identify what those are. And the reason why this is so important is we just want to give you a real quick example here. We do want to open it up for some questions, but we want to give you an example here of how increasing that score can actually help you increase the number that you get for your business, because it's not all just about the income statement or the numbers. So Erin's going to just quickly go through this Ebitda example, and then I'll go through the multiple change.
Yeah, so earlier in this presentation, I was explaining how there's multiple ways to value your business. And one of them that a lot of companies focus on or use when they're selling their business is starting with their Ebitda. Or as it says on the right-hand side here, it's the calculation of your earnings or net income before your interest expense, income taxes, depreciation, and amortization. So here is just an example of how you would even calculate that. I typically tell people just take your financial statements and you start adding things back. And even on here, you can see kind of lower on this schedule here is we also do, when you're selling your business, try to factor in things that are just specific to you. So if there's things called, maybe you're getting paid some fringe benefits, or you have your company vehicle in there, we would also consider adding those things back to come up with a normalized Ebitda that will be used for, valuing your companies in the future. So the next slide here. Whoop.
Yeah, and some of those could be like excess rent. If people own the building that the operating entity is in, they might be charging more rent. So that could be another example of, we just want to make sure that things are normalized before we do any type of calculation. So on the next slide here, we're just going to tell you what that looks like. And so if you had Ebitda of 450 and you had an assumed multiple of 3.5, you have estimated value of 1575. Now, if you could get that income up to 600,000, I know that's easier said than done, but there's ways that hopefully people got some insight out of this into doing that. If you could get that number up, it's not just $150,000 difference, it's 150 times the multiple of 3.5. So now you're looking at about a 2.1. And in this situation, we're assuming that there's no debt. It's a very simple calculation just for example purposes. So now what happens if we can increase that multiple? So now we're going to see, and here's my results. Was first an increase of 525 with increasing your net income. But now if we can increase that multiple to 4, now we have a value of 2.4 million, which is an increase of 825,000. So it's really important to understand that what this value builder does is it puts you in place to get the highest multiple you can for your organization. Yes, you can change your income to a certain extent, but even if you were at 450 and you got a higher multiple, the value builder is going to help you get the highest multiple, because it's going to create a company that has value within the organization. And that's going to be a win-win for both buyer and seller. And I think that kind of rounds out here what we have. So I just want to remind everyone that there are 2 assessments that you can take as a result of this webinar. So you can take the exit planning assessment that can help us determine where you are in your exit planning, talk about the owner objectives, talk about the personal and financial resources. And then you can also take this value builder assessment that really just focuses on increasing the value of your company. So I hope that you've gotten some information out of this webinar, and I think Lee is probably going to open it up to some questions now.
You got it, Nancy. Nancy and Erin, a ton of information, so much good stuff, so much for business owners to think about when they're going through this process. Thank you both. We have had a couple of questions come in, but I do want to open it up to everybody. Feel free to open up the chat box in Zoom and submit your question to all panelists. While we wait for those to come in, I'm going to ask a little bit of a self-serving question, but I think, as I'm listening to this, I feel like this might be on a lot of people's minds, and that is a lot of information here, a lot of things to talk about. You talked about the different, the 7 or 8 different steps. How do you actually go about working through this process with people? Can you talk a little bit about what that looks like?
Yeah, so typically what we do is we meet with individuals first to figure out what their objectives are. And so I think that's something that people don't really understand is people really need to think about what they want from their future, think about where they want to go, and we can actually lay out a plan for them on steps that they need to take. And obviously some of the first steps that we talked about is really taking an inventory of your income and really meeting with a wealth advisor. That is going to be very important early on in the process, as well as determining an estimated value of your company. And again, doesn't mean that you necessarily immediately have to have a full valuation. There are ways that we can do some preliminary numbers before we do that valuation, just to get an idea. But we can certainly help people and we can tell them what the steps are and help guide them in those steps. One thing that it's important to understand is it's not just us, SVA, who is responsible for everything. We're kind of the quarterback when it comes to a succession plan. As I mentioned, a wealth advisor, you're going to want to get an attorney involved, a valuation expert if you need a valuation, which we can do, by the way. So maybe that will be SVA. But there are other professionals that you will need to get involved along the way. But again, that's where we can help you by creating a comprehensive plan or roadmap into those steps that need to be taken. And it's never too early to start.
Well, that was a question that just came in, and I think you sort of answered it. How long should this process take? How much time should people give to work through this process?
Yeah, it really depends how far along they are in understanding what their objectives are. You know, do they know they're going to sell to a third party? Do they already have management identified that they want to sell to? Have they had conversations with management? I would say typically, if you haven't done anything yet, you're probably looking at 5 years. Now, I have seen situations where we can get through it a little bit quicker, but I would say really to make sure that everything lines up, you probably want to start about 5 years before. And again, it doesn't mean that you even have to sell in 5 years, but you want to have some of these things buttoned down, because we saw a lot of businesses last year that got people, you know, that got knocks on their doors or phone calls saying, hey, do you want to sell your business? And they weren't ready. So this just really helps people get ready. So when the time is right, they're ready to go.
Okay, we've had a few more questions come in. How do you balance gaining value in the business versus making the purchase reasonable to sell to a family member, especially a child?
Oh, that's a great question. Yeah. When you're looking at selling to a family member or a child, there are ways that we can structure the deal, and there are things that we can do. It can be a combination of gifting and purchase. You know, I will say that I am a big proponent of having some skin in the game. I don't know, maybe it's just my generation, I don't know, but I think it's important that having some skin in the game creates some accountability and a little bit more percentage of success, I think. So I do think that it's important to have part of it as a component of a sale and making sure that they're ready. And we can help people. We've done it before where we've laid out what's a reasonable price, balancing that, what's a reasonable price and how can they pay for it, and creating a plan that they can actually use company profits to make the payments to the family member. So it can be done. It's a little bit of a balancing act, but it can absolutely be done.
And Nancy, I would imagine that, you know, out of the 8 performance drivers that you discussed, the overwhelming majority of those, if not all, are just good business practices to begin with, right? So now you're handing over a healthier business to a child or to the next generation.
Absolutely. You hit the nail on the head. You know, we did focus this on succession of a business, but the reality is this should really be called probably success of a business, because yes, every one of those 8 drivers is just going to help a business be more successful, whether they sell or not. You know, I would still prefer as a business owner to have my business do well and be able to take more out of it than to have it not do well and be limited on the proceeds that I can take out of the business, you know, in day to day. So that's a great point, Lee.
Another question that just came in, how much will it hurt the value of my business to have the majority of my revenue come from one customer?
That definitely hurts the value of a business, because if you're looking at somebody buying that, they're going to have a lot of concern that if they lose that one customer or contract, the business has no value anymore. So that is something, and this is actually one of the reasons why some businesses, it takes longer than 5 years, because they need to make sure that perhaps they don't have all their eggs in one basket. Yeah, because you certainly want to ride the success of that one customer, absolutely, but you need to be able to have a plan in place to replace that customer if something were to happen, because that is definitely going to be a very big concern of anybody taking over that business.
Right. Think of it as Nancy's sports metaphor of the backup quarterback. You don't want to just be reliant on one person, because, you know, if Aaron Rodgers goes down, I don't know how many of us really love Jordan Love, but that's our backup plan. So, you know, you got to have those options out there.
I like it, Aaron. That's an analogy that will resonate with this group, I think.
That's what I figured.
So another couple more questions, and then I think we'll wrap up because we're getting close to the end of the hour. So do most people sell the business's real estate when selling the business, or is it smarter to hold on to the real estate and collect rent from the buyer?
Yeah, that really goes back to depending what your personal financial plan looks like. If you have a financial plan that you need steady monthly cash flow, and the real estate is providing that to you, you know, sometimes I encourage people to hang on to that real estate and collect the rent because it's giving them that cash flow they might need. Now, if you're selling the business, some people might, the thing you have to consider is rent contracts. Is somebody coming in? What type of rent contract are they going to want? Are you going to be able to enforce a rent contract to them? Are they willing to sell it if you keep the real estate? So there's definitely things to consider, but it's really going to depend on your financial position in selling that real estate and the desires of the buyer. You know, a lot of times if it's family members or inside, then original owners might keep the real estate and the family member, the insider, might just continue paying rent because it might be an issue that perhaps they don't have the money to fund the building purchase at that time.
Okay, last question we'll take. Somebody says, I've been hearing a lot about Esops. Can you talk more about the pros and cons of Esops? And then maybe just having the tilt on it of the adding business value, can you talk maybe a little bit about the difference in what you might get at the end when selling your business to an Esop compared to a different type of sale?
Erin, do you want to take a crack at this one?
Ooh, Esops. The pros are you're selling it to your employees. That hence the word Esop, employee stock option plan. But they are going to have to take out, so you do have to have a formal valuation done every year when you're going to sell to an Esop. And Nancy can probably fill in the gaps for some of these areas. But you also are likely, usually the Esop has to take out a pretty substantial loan to pay that business value. So just be mindful that they're going to have to fund this purchase through the Esop in order to pay you back. So we Nancy and I have a client where they're actually going to pre-fund their Esop purchase. And then once they actually start to sell to the Esop, part of that funding's already happened. So they don't have to take out as large of a loan. But again, kind of going back to Nancy's thought of, you know, having people having skin in the game. This is kind of like the employees now having skin in the game and getting some, you know, benefit from being an owner through their retirement plan.
Yeah, so I have a great candidate for an ESOP is a company that wants to continue their legacy. They are a successful company. They want to continue their legacy. They want to continue their employees working there, but they don't have a succession plan. They don't have any one individual in the company willing to take or having the financial capability of taking it over. They don't have any family members. But the company is very well managed by a good management group of people. That's a great candidate. And honestly, for the individual selling the company, they're going to get a decent value for the company, because as Aaron said, you're going to get a formal valuation. It's not like they're selling it, for pennies on the dollar to an Esop. They're going to get a valuation. They're going to get that fair price for the company, and they have the ability to continue running the company, because the company still needs a president or a board of directors or a CEO to help run the organization. So they're going to continue in the management of the organization, the operating of the company, but they just don't technically own it anymore. Esops also do not pay income tax. So there's a really good income tax benefit to selling to an Esop. And I think probably Dan is going to get into that a little bit more in the last session, the income tax impact on any of these, but Esops are great from an income tax perspective. So oftentimes the tax savings outweighs the cost of the valuation every year. So they're really gaining momentum, and for certain companies, I think they're great options.
Yeah, thank you, Nancy. You're right. We've been seeing a lot of those recently. They seem to be becoming much more popular. All right, Nancy and Aaron, thank you both so much good information. Just as we wrap up here, I'd like to let you all know that you can visit SVAaccountants.com, where the recording of this webinar will be located, as well as e-guides and articles and upcoming events. There's also the exit planning assessment questionnaire that Nancy mentioned, available to you to complete, that can help you assess where you are in the exit planning process and sort of where you need to get to. We'll get the results of those questionnaires and can help you develop a written plan based on your goals, objectives, and concerns. So part 2 of our exit planning series will be on November 2nd, and the topic will be understanding the role of valuations and due diligence for a successful transition. Then our 3rd and final will be on December 8th, and that will be about how to minimize tax implications with estate and tax planning. I know we're having some technical difficulties. Hopefully you all can see that. Reach out to us if there's anything else you need to see. But lastly, I want to remind you all in the webinar that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. If you're not currently an SVA client, please reach out to me, Lee Schwartz, and I can help get questions to the answers that you need. Thank you all again for joining us today. Have a great rest of your day, and we hope to see you at our next webinar on November 2nd. Bye-bye.
Thank you, everyone.
Thank you, guys.
Have a great day. Bye.